everyone. This is Gilbert Jalad. I'm talking to you from CPLSPA downtown Orlando. This is Tufts on Tax, where all your tax questions are answered right here with Mr. T. Scott Tufts, the master and the expert when it comes to tax laws. You can actually call us at 877-647-7887, or you can reach him at stufts@cplspa.com. Again, that's 877-647-7887, and the email is stufts@cplspa.com. Hello, Scott. How are you today?
Hey, good to be with you.
Good to be with you, too. And we have a topic that we talked about previously in the past, operating agreements. And you were showing me before we got on air an example of that. So
Right.
What is an operating agreement?
Right. So we are talking about an agreement that will govern an LLC and what its owners understand to be the rules of the road for what they've come up with to govern how they're going to operate, manage their business.
Mm-hmm.
Okay. And the provisions and oftentimes are in pages and pages of agreement. And I was just showing you one before we got on the air.
Correct.
Which is very technical, but one of the things that they have general features to them. You'll have a cover page and it might look nice and it talk about securities provisions, and depending on where the LLC's from, whether it's Delaware or Florida.
Okay.
And then you'll have a table of contents that will walk you through some 40, 50, 60, 80 pages.
Mm-hmm.
And many people find themselves with an operating agreement that they really don't understand, or that there are multitude of provisions that they have focused on, but maybe some other ones that it went over their head, especially tax provisions. And what we are trying to get the word out is that you cannot gloss over the provisions in these agreements without understanding them. And yes, it might take someone with expertise or a background in partnership taxation if you got an LLC tax like a partnership. But it is critical for you to know that when you see terms you don't understand, you ask questions, right? You say, I don't understand this. Why do I need this? You'll see things like a capital account or provisions that have to be maintained in accordance with, and they'll cite to sections of the Internal Revenue Code, most notably Section 704B of the Internal Revenue Code. And I can't tell you how many times people will just gloss over that, and they have no idea what that means. And if I say something, someone may say, well, Scott, those are terribly complex. I trust that the accountants will know what to do. Well, if there are certain elections to be made that will favor one member over another member, you better care, because that will hit you in the bottom line. But if you don't know enough to ask, and you don't know enough to get into the agreement, and you don't do some examples in your mind of how your relationship will play out, you might get bit, and it's going to be too late if you wait until after the ink has dried, so to speak.
That's true.
Also, one of the things I sent to you before we were talking is there are sections that deal with a duty to keep the books and records. And what does it say about the K-1 in it? Mm-hmm. What does it say about your right to the records of the company? And then we also have talked about what does it say about a tax matters partner? Who's going to be in charge of the entity when it goes through an audit? And believe it or not, it's not necessarily the managing member. It's going to be who you've designated under the terms of the agreement. And what we are looking for there is a partnership representative under the BBA, which is that Bipartisan Budget Act. And so, again, this is very technical, but what we've got to get people to understand is that there's boilerplate provisions. You sign off on it, and if you don't know how it works, it can bite you. And what broke this for me was that here I've got a case, and this kind of shows how we're breaking news, right?
Correct,
so
yeah.
Everybody wants to be breaking news. Well, I've got a case, October 13th, 2022, out of the tax court. Clark Raymond and Company, PLLC v. Commissioner. It is a case that discusses in 35 pages, according to the way that I've got it printed up here, where they specifically go through the agreement and these boilerplate provisions that say we will maintain our capital accounts in accordance with Regulation 1.704-1 B24. Well, if you don't understand those regulations and you've kind of just gone right along with it, you might not realize that there are significant issues that occur when you're under these rules. For example, in the case that this came out and discussed, it was a number of entities that were operating as the owners, right? And then the individual owners of those entities that had all formed together for a partnership in an accounting firm, they ran into problems when the partners left. So the partners leave, they're employees, and they're leaving the entity, and they're taking their book of business with them. How do you value it? These rules actually, inside the tax code, talk about booking up the value, valuing an intangible asset that may not be on the books as so. And so what is your agreement saying is going to happen when that happens? And is the agreement that you have going to work? And most importantly, is what's on the K-1 proper? So it's got a very practical impact when you're going to leave the partnership and you've got to comply with these rules. Who knows them? Who understands them? They're very difficult, and that's kind of what we're up against here. So I kind of saw this case and said, wow. So what I get out to everybody on this is, believe it or not, these provisions that are pages and pages long, provision after provision, dealing with fancy terms like partnership minimum gain, qualified income offset, maintain your capital accounts, doing it a certain way. I can't tell you how many times, it will gloss over. People say, well, we don't worry about that. You have to worry about it because it is your governing terms that guide when you get out and when you get in. Okay? So it is critical for our folks out there to understand that if you've got a complex partnership or limited partnership agreement, operating agreement, you got to look at it. And hopefully you're looking at it before you sign it. But even if it's after you sign it, get to work on what does it talk about in the tax provisions. What are your definitions say? Who is the partnership representative in case of an audit? What will be the rules on what records you can get access to? And then how do these rules actually matter in a practical way? Are you running through the hypotheticals to see how it can affect you, right? So, we're not asking them to understand all these tax provisions. But as a practical matter, I assume if you're in business with somebody, Gilbert, you're going to want to say, okay, so in 3 years if this doesn't work out and I go to exit out, how is that going to work? Correct? You'd want to go through those discussions ahead of time, and you want the tax laws to work in coordination with what your expectations are. And the worst thing that can happen is if things go sideways. And that's kind of what was happening in this case. And, interestingly enough, just to show you that in real life terms, here's this October 2022 case. And right out of the box, I saw this in here as I was looking at it. It says the partners filed Forms 8082, Notice of Inconsistent Treatment, or Administrative Adjustment Request, contesting their income allocations, which led to an audit. So right here we're seeing right there that indeed it is as we talk about. The 8082 becomes the challenging document that leads to litigation, except this is with the IRS. And so, something you got to be on top of. We spoke about an
example like that.
Right. And then, but for the folks out there that say, okay, what about just in regular business? I got a case that I found out of North Carolina, dealt with a different LLC as far as an operating agreement up in North Carolina. But the bottom line was they were walking through the same sections of the operating agreement dealing with these capital account maintenance rules and what happens when they're not maintained properly. And the discussion becomes, what do you do when you're going to get out? And, there's things like guarantee payments and how did they describe them and the confusion that came up. They talk about how they got in a real life dispute because two people kept getting money out of the business, but the third one did not.
Wow.
And the agreement said all three should get should get distributions. And instead, they kind of got cute, got it out to two of them, and so they were able to get an injunction in the case. Now, that doesn't mean they're going to necessarily win, but the third partner out, or member in that case, was on the outside looking in, was able to get an injunction. So, again, that's Norman v. Rabone, and the other case
So
from the
they
tax
don't
court.
fall into something like that. Do they need a lawyer like you to go over
Of course.
the documentation?
So you ideally you preempt the situation
Yeah.
by robust review of your agreements before you sign them. But if you sign something and you worry later, hey, maybe I shouldn't have, then you're going through the process of review, because then you start negotiating for an amendment, correct?
Okay.
Because you say, I need an amendment, so they can come see somebody like me for that.
Correct.
Now, let's say it's even after that, you've already had the split and you're in a dispute. Now you hope you can work within those provisions, because there's a lot of twists and turns and interpretation within these tax law provisions. And then last but not least, if you get audited and you've got your partnership rep in there and it isn't you, the good news is it isn't you. They're in charge. The bad news is they're in charge. So which way do you want it? You want to be in charge and deal with the IRS yourself, and you answer for everybody else, and you make the final decision? Or do you want to be on the outside looking in and ready to take shots at the, not literally, but, be upset or something with the representative? And what is your agreement going to say about reimbursing costs for that person, right? And are they under a fiduciary duty, and so forth and so on? So our audience has to get the idea that if you've got an operating agreement or a partnership agreement, look at it right now. If it doesn't say that who the partnership rep is and doesn't use words like the Bipartisan Budget Act of 2015, if you don't see stuff like that in there, or you're not clear how it's going to work on different scenarios, you need to be clear. And you need to figure it out. So get to someone like me who can walk you through your agreement and do that kind of review. And so that would be ideal. Don't wait for the proverbial shoe to drop, and then you're in litigation and you don't know where you stand.
So how would you be able to help them when they reach the level of these examples that you're showing us?
So what we can do in these situations is we have to understand their business, how it relates the paper to their reality, but we walk through what the numbers are. We'll need the financial statements or some kind of idea of how far they're operating. Are they just new into the business, so they put up money and someone else put up property, or did they borrow? What are the arrangements? What's the paperwork going to look like? Pretty robust review, if you will. And then you're looking at, well, what does the K-1s look like so far? So we grab the tax returns if you can get them. And then you want to look at them and compare them to the K-1s. And ideally, you have all the K-1s, so you get to see what your partners are doing on their K-1s. And then you're able to start looking at that way, if that makes sense. And we work side by side with the accountants, because we ultimately, either whether you need an expert or a review, or, as I've told the audience in the past, sometimes the accountants do the entity level and then they'll do everybody's return. Right? Now, that's great for them. They got all that business. But if there are decisions that favor one partner over the other, who's making that call?
Exactly.
And right? So who does that accountant answer to, and which partner, and how do they make those calls if one can go one way and it can go the other way based on the makeup or composition of that LLC? So yeah, it is not for the faint of heart, and it certainly adds a cost to doing business, right? It's not a simple thing. This is why partnerships, LLCs that are not S corporations, can operate with a little bit more, or operate with both flexibility and complexity. Correct? And one other thing I'll say, so even this tax case, I saw the reference made to what did they call the agreement? They called the provisions. I think they referred to them as, and just bear with me one sec, it said it had sophisticated partnership tax provisions. So I would suggest to the audience that sophisticated tax provisions are going to exist with S corporations, but S corporations operate more on an equal basis because the shareholders have to be treated equally, pro rata, and some of those protections. a little bit more wild west with the LLC partnership type documents. So again, if you get these things and you're looking at them and you need it reviewed, get to somebody like me, get that review done before it's too late, before you hit the litigation and things go sideways.
Absolutely. Great advice. Okay, folks. Well, you heard Mr. T. Scott Tufts. If you have an agreement like that and you need to review it, have someone professional, expert that knows everything about this, like Mr. T. Scott Tufts. You can call him at 877-647-7887. Again, that number is 877-647-7887. Or you can email him at stufts@cplspa.com. That's stufts@cplspa.com, and we'll see you next time. Thank you.